Hello everyone, and welcome back. We've entered the final stretch of 2025. November has brought a significant chill to the crypto markets. After months of steady gains and bullish sentiment, a sharp correction is now underway, catching many by surprise. The optimism that carried us through the summer has been replaced by a wave of uncertainty and fear. Prices are down across the board. Key support levels are being tested for the first time in months. This isn't just a minor dip, it's a market-wide event forcing everyone to reassess their positions and outlook. Institutional giants, retail traders. The biggest headline is Bitcoin. Bitcoin has fallen below the $100,000 mark. This is a major psychological blow. We haven't seen prices this low since June. The speed of this descent has been jarring. The move triggered a cascade of liquidations and panic selling. Altcoins have fallen even harder. Is this a temporary setback or the start of a longer bear trend? The answers are complex. The data paints a mixed picture. Fueling the downturn. Significant outflows from spot Bitcoin ETFs. ETFs were a primary driver of the bull run earlier this year. Their reversal is a major cause for concern. Reports show large-scale institutional selling. Big players who bought aggressively months ago are offloading. This shift in institutional behavior is a critical development to watch. The correction isn't in a vacuum. Macro uncertainty persists. Regulatory discussions are heating up again. The new Trump administration's developing stance on digital assets is being closely scrutinized. Every comment and appointment could sway sentiment. Corporate updates, regulatory updates. It's a perfect storm of negative catalysts, creating a dangerous environment for investors. Understanding these interconnected factors is essential to navigating what comes next. So, why should you pay close attention to what's happening right now? This moment is pivotal. The events of this month could very well define the trajectory of the crypto market for the next 6 to 12 months. Whether you are a long-term holder, a frequent trader, or just someone curious about the future of digital finance, we are at a crossroads. The market could stage a powerful recovery or slide into a prolonged downturn. Understanding the key drivers and signals will help you protect your capital and identify opportunities. In the next 15 minutes, we'll break this down into clear, understandable pieces. I'll guide you through the noise and focus on the facts that matter. First, a rundown of the major headlines. Bitcoin's price action, ETF outflows, institutional selling pressure. Then, we'll connect the dots between these stories. Let's begin with the news that has dominated every financial outlet this month. Bitcoin, the market's undisputed leader, has fallen below the crucial $100,000 psychological support level. This is the first time we've seen Bitcoin trade this low since late June. The break below this level was not a slow grind. It was a swift, decisive move that sent shockwaves across the market. On November 12th, the price sliced through the support line with heavy volume. That heavy volume signaled strong selling pressure. The drop continued to a monthly low near $94,500 before any temporary footing. This wiped out nearly 4 months of gains in a couple of weeks. The $100,000 level's significance cannot be overstated. For months, it acted as a solid floor. Each time price dipped, buyers stepped in, reinforcing belief in a new base. Its failure has shattered that confidence. Psychologically, it's a major blow to retail investors. Psychologically, it's a major blow to institutional investors. The breach triggered automated sell orders and derivatives liquidations. Those liquidations accelerated the decline in a cascading effect. The Crypto Fear and Greed Index has plunged from extreme greed just last month to extreme fear today. This indicates retail investors are panicking. We see it in social media sentiment and search trends. Search queries for crypto crash are spiking. Search queries for is Bitcoin dead are spiking. Seasoned investors know fear can present buying opportunities, but the current environment is filled with uncertainty. Price is struggling to find a new support level. Every small bounce meets renewed selling, suggesting the bears are in firm control. One of the most significant drivers of this downturn is the shift in flows for the spot Bitcoin ETFs. These products were the heroes of the bull market earlier this year, but have now become a major source of selling pressure. We're witnessing sustained multi-week net outflows. The week of November 11th saw a record outflow of over $1.5 billion from all US-listed spot Bitcoin ETFs combined. The steady stream of capital that provided constant buying pressure has stopped, and it's reversed course. ETFs are a direct line to traditional finance and institutional capital. Their initial success signaled mainstream acceptance. Now the outflows suggest the fast money from hedge funds and other short-term institutional players may be taking profits or de-risking, creating a feedback loop. Falling prices, more ETF outflows, more selling, and even lower prices. Key date, November 14th. Grayscale's GBTC had its largest single-day outflow ever, shedding nearly $500 million. Closely related to the ETF outflows are broader reports of institutional selling. On-chain data shows that large wallets have been moving significant amounts of Bitcoin to exchanges. Blockchain analysis firms have flagged several large transactions originating from wallets that had been dormant since the accumulation phase of late 2024. This suggests that long-term, large-scale holders are now cashing out, taking profits after the substantial run-up. Why are institutions selling now? First, many are likely securing profits before the end of the year. Second, the uncertain macroeconomic outlook. Finally, the shifting regulatory landscape. This shift in institutional behavior is a crucial piece of the puzzle. When institutions were buying, they provided a stable floor. Now that they are selling, they are creating a formidable ceiling. The market correction is not just about price and flows. It is also being influenced by a shifting regulatory and corporate landscape. In the United States, the new Trump administration's stance on cryptocurrency is beginning to take shape, and the initial signs are mixed. Key appointments to agencies like the SEC and the Treasury Department are being watched very closely.
A desire for stricter oversight of stablecoins and DeFi platforms. A recent statement from the newly appointed Treasury Secretary hinted at a desire for stricter oversight of stablecoins and decentralized finance platforms, which sent a chill through the market.
This uncertainty from the highest levels of government is causing institutional players to pause. Large firms require regulatory clarity. On the corporate side, a major publicly traded company announced on November 18th that it had sold a portion of its holdings to fund operational expenses. While the sale was relatively small, it was symbolically significant. It broke the never sell narrative that many corporate adopters had promoted. This was followed by news of a prominent crypto lending platform halting withdrawals, reigniting fears of contagion and counterparty risk. These events contribute to a powerful narrative of fear, uncertainty, and doubt, often referred to as FUD. When prices are falling, the market becomes highly susceptible to negative news. The combination of potential government crackdowns and signs of stress in the corporate crypto sector creates a difficult environment for investors. Let's explore the most optimistic potential outcome: a short-term pullback followed by a strong recovery. In this scenario, the current correction is seen as the final violent shakeout before the bull market resumes its upward trajectory, leading to a decisive V-shaped recovery. This would involve Bitcoin rapidly reclaiming the 100,000 level and, more importantly, holding it as support. For this bullish reversal to materialize, the most critical signal would be a halt and reversal of the ETF outflows. This would instantly change the market narrative from fear to opportunity. A confirmation signal would be the price decisively breaking above the 115,000 resistance area. This would invalidate the bearish structure. Practically speaking, traders watching for this scenario should pay close attention to the daily ETF flow reports. Coupled with a spike in spot buying volume on major exchanges like Coinbase, Additionally, a flip in futures funding rates from negative back to positive. If these data points align, the November correction will be remembered as just another healthy reset. Now let's consider the most pessimistic outcome, a prolonged bear trend. The break below 100,000 was not a temporary dip. It marks the start of a much deeper, longer correction. A key technical signal would be a firm rejection from the 100,000 level, confirming that former support has flipped into a formidable resistance ceiling. The next major support to watch is around the 85,000 area. A break below 85K opens the door to a much deeper decline. Targets as low as 70,000 become plausible. In a bear market, even good news fails to move the price sustainably. That's a strong sign the underlying trend is down. In this scenario, capital preservation becomes the primary goal. The market would be signaling the cycle top, and a long crypto winter has begun. Between the extremes lies a third, and perhaps most probable scenario, a prolonged, volatile, range-bound consolidation. Instead, the market becomes trapped in a wide, choppy range. For example, $90,000 on the low end, $110,000 on the high end. This represents a market in equilibrium. ETF outflows slow and neutralize. On-chain shows mixed behavior. This environment wears out bulls and bears, declining volume and apathy. Time frame, potentially 3 to 6 months. The market needs time to absorb the sell-off and for a new narrative to attract capital. The key indicators are the boundaries of the trading range. A break below support signals a move toward a bear market. A breakout above resistance signals the consolidation is over. As we conclude, it is clear that November 2025 has been a pivotal month, driven by a confluence of ETF outflows, institutional selling, and macro and regulatory headwinds. Given this uncertain environment, it is crucial to consider practical actions. For short-term traders, this is a time for extreme caution. For long-term holders, the strategy is different but requires discipline. Across all investor profiles, stay informed but filter out the noise. Focus on the primary data points, ETF flows, on-chain whale activity, and major regulatory announcements. The bull market's easy gains are behind us. Whether this is a temporary storm or a new season, risk management and informed analysis remain your most reliable guides. Thank you for joining me today.